Welcome to Trading Day. I'm Roger Peterson. Thank you very much for joining us. Let's get to some of the stories we're following in the BNN Bloomberg newsroom. Descartes is one of the best performing stocks on the TSX today. The software firm reporting revenue in its latest quarter that jumped 11%, exceeding estimates. Revenue in its service segment also topped expectations and came in 16% higher than the year before. Descartes warns, however, that continued uncertainty and tariff volatility is contributing to forecasting, planning, and execution challenges for its clients and customers. Shares of BRP are getting a boost in today's trading. That's after the maker of all-terrain recreational vehicles saw revenue surge 15% compared to last year in this latest quarter. It also posted higher profit that topped expectations. The results were driven by higher off-road vehicle deliveries and new product launches. BRP also hiked its 2026 forecast for profit and revenue and will buy back up to 10% of shares. Shares of Canada's Horizon Aircraft are up today, about 5% right now. The innovative aerospace company announcing it has partnered with a UK-based Motion Applied to design a key component for its hybrid electric flying taxi. Motion Applied, which split from the McLaren Group in 2021, supplies engine control units to several motorsport series and makes electric vehicle charging equipment. Well, a good day on the markets right now. The TSX, at least you can see it's up almost 1.1% and into record territory with that surge. South of the border, bit more mixed, bit more mute. You can see it's pretty much a wash. The S&P 500 up ever so slightly, Dow Jones neutral, and the Nasdaq up 0.14%. Hardly worth mentioning right now. Well, bank earnings are continuing to roll out today. The Bank of Montreal, TD, CIBC all reporting. Dan Rohinton, portfolio manager at IA Global Asset Management, joins us for more on this. Dan, thanks as always for joining us.
Good to see you.
Okay, let's start with the Bank of Montreal, just because we have to start somewhere.
Yeah, I mean, overall, I think there's not a lot to complain about in the quarter. There's a general theme, such as strong capital markets, the loan growth coming in pretty strong, and capital levels that are pretty adequate across the board. The only thing with BMO that was a little bit unique was that the guidance was a little bit squishier on a go-forward basis. So of the results, it was probably the weakest, but I think that's really threading the needle on that one.
And what, the squishy message, what didn't you like about it?
It's just on the forward outlook of credit and the general anxiety. So companies like Royal Bank were also talking about yesterday when the results came out that they were just nervous about macro, what tariffs could look like as they move towards next year. It just hits a little bit harder with BMO because they're a lot more focused as a commercial lender relative to Royal, which you can say, that's fine because over 50% of your earnings are fee earnings. So it just hits a little bit harder with BMO when they talk about it.
And what would you like to see them focus on for the next quarter?
I think it's broadly the same execution. It's really just credit's something you can't really control all that much because the loans you have on your books today either came on 6 months ago or 2 years ago. So on a go-forward basis, they're probably all a little bit more cautious on some elements of commercial lending. But this really is not a BMO-specific issue. It's just BMO's mix is higher. All
right, let's move on now. CIBC, Mr. Consistent, can we call it? What's like the 2-year streak of earnings beats?
Yeah, it's been a phenomenal run for CIBC, and at its core, there's diversification going on with the U.S. area, U.S. country as well. But really comes down to the Canadian housing environment, the Canadian consumer being pretty well robust in terms of credit losses. So CIBC is by far the most leveraged proxy to that, and you can see that in the stock over the last year and a half, how much it's really recovered. And that's largely been a function of Canadian consumer expectations coming in a bit more optimistic than investors would have hoped, and the valuation really ripped and teared from there. One thing I'd leave you with on CIBC, Roger, is that we're talking about generationally high valuations across the board for the banks. That's absolutely true for Commerce as well. So this is by far the biggest success story in Canadian banking, but I would also say it's the highest beta proxy. So this one, just like BMO, can't really pivot away from its future all that much, given its commercial roots and its footprint. Commerce also has that dynamic, but they're more of a Canadian consumer conversation.
Okay, and last one I want to get in for now is TD Bank. You like this quarter for them and think investors will see this is the day's winner?
Yeah, I think so. Valuation, once again, there's been a tremendous run in TD, so I think it's important to take stock of that. So the discount that came with the asset cap is more than well taken care of at this point. But loan growth and asset growth as a whole was actually quite robust, which I think is quite impressive given what is going on. And there was a little bit of weakness on gross impaired loans for them. I believe, if memory serves correctly, about 100 million or so from last quarter. But for a loan book this size, that's really small potatoes. So I think investors will continue to see TD basically as the proxy beta stock for now, because they have the asset cap, which is, if they can keep going on this track, it's going to get removed. So the U.S. capital deployment and the growth can kick off further from there. They have a common equity tier 1 ratio, if I recall, 14.8% this quarter, and they still have more buybacks to be done. And loan growth is still holding in despite all of that. So the charges will get cleaned up. The earnings growth is going to keep accelerating. Do I think consensus numbers are mostly already pricing that in? I do, but we're in this type of market where the banks are getting definitely their benefit of the doubt. So I'd expect that to keep going. And TD, along with Royal, I think had the best quarters this earnings season.
Okay, and looking at the whole package, the whole picture, how does this week stand out for you for earnings week for the banks? We had some interest. We had announcements of sales. It's been an interesting week.
Yeah, I mean, this is probably even the busiest quarter in Canadian banking in a while. So I'll start with what came out at the start of earnings season, which was Laurentian Bank is being, I wouldn't say gracefully wound down. I'd say it's more appropriate to say it's being carved up by Stephen Smith and Centerbridge for parts of their loan book and the specialty business. And their job is to then close all the branches in Quebec, which is going to be a bit of a challenging endeavor. And then National Bank buying the loan book. So call it National, and the Stephen Smith empire wins that transaction to the detriment of Laurentian Bank employees, more likely than not. Mm-hmm. So that's a bit of a difficult starting point to the week, but good for certain people, difficult for others. Then you move on to, generally speaking, robust capital markets across the board. And that was the real shining earnings story here. On top of the fact that credit, aside from the odd question that we saw here and there about private credit exposure in the U.S. market, some pressures in the GTA market, overall, I think it's fair to say investors are really saying credit's a non-issue right now. And then that's what's driven valuations across the board up to generational highs. And I don't think that's an exaggeration to say that. So if you can go back to the valuation of RBC in the late 90s, we're at those levels. So we're basically there. So what does that mean on a go-forward basis, if you'd allow me to ramble a little bit? I think as we look to next year, the outlook as it stands is for mid to high single digits EPS growth and a 4% yield for on average for these companies as we look ahead. The question is, are there going to be surprises? Because I don't think there's a lot of room in the numbers to go much higher from here, outside of a little bit more on the buyback side, releasing a bit of capital and a bit of faster loan growth. But that's 1 or 2% at most. Mm-hmm. So it's really a question of, as 2026 rolls around, I'd ask and encourage our friends on the other side of the screen to just ask themselves, what are some of the fears and anxieties that might actually percolate into the numbers of the banks? Because I do think we're reaching the point where there's probably a more downside than upside, but that's more looking for a catalyst negative as opposed to anything that we see today.
Okay, we're going to have to leave it on that note there. Dan, thanks as always for joining us.
Good to see you.
Dan Rohinton, Portfolio Manager at IA Global Asset Management. Well, EQB is buying PC Financial from Loblaw, a deal worth an estimated $1.3 billion. We'll take a closer look right after the break. EQ Bank is acquiring PC Financial, the financial services brand of Loblaws, and the news seems to be benefiting both EQ and Loblaws. For more on this, we're joined by BNN Bloomberg's Lindsay Biscaya. Lindsay, let's another Another banking story, some changes happening when we thought there weren't many banks to be sold. Apparently there are.
Well, exactly. And this is an $800 million deal, and Loblaw is potentially taking out an even further stake in this. So first of all, it'll be 17%. But we know some analysts are saying that could go up to 25%. So this is a big deal. We're talking about PC Financial here. You might see their ATMs all over the place and their stores within Loblaw's as well. And this kind of joins together two big machines. So we're talking about the digital side of things with EQ Bank and then the retail side of things with PC Financial, owned by Loblaw's, of course, getting that together and customers benefiting from both sides of it, right? Able to use the app through EQ Bank, but also able to access like the credit that comes with PC Financial. You're talking about 2.5 million customers that have that credit. And then you're also talking about 800,000 customers within EQ Bank. So kind of this joining together in this big mega deal, and shareholders expected to vote by the end of the year.
All right. Synergy is what they talk about. What are analysts saying with this one? Yeah,
well, analysts are focusing a little bit on Loblaw's rather than EQ Bank. So we'll start with Desjardins, focusing on the big positive for Loblaw's. They're saying this is imperative to Loblaw's scale, or it's not imperative to Loblaw's scale, but Loblaw's will be able to focus more on the retail side of things rather than the financial side of things. Raymond James, meanwhile, focusing more on EQ Bank, saying they expect this deal to be beneficial over time. It's maintaining the market perform rating, though, because over the near term, EQ Bank still has a lot of issues with credit. And we saw that with their fourth quarter earnings, which came out today. They missed estimates, and a lot of that based on their credit issues that they're still seeing, which they saw last year as well.
Yeah, there was some concerns about the credit with how things unfold. They said the CEO we're going to be talking to said we had a bad year. I think the quote was a challenging year.
It was a challenging year.
It was a challenging
year.
Yeah,
they say that they kind of came out on top when they're talking about EQ Bank. They called EQ Bank the crown jewel of the company because EQ Bank saw 18% year-over-year growth in customers, 10% growth in deposits. So the stock price up today. Wow. Last I checked, it was up just over 10%. So now it's almost at 13%. So even though they kind of missed estimates in their fourth quarter and are maybe not doing so well, this news of this acquisition of PC Financial really seems to be boosting their stock. Yep. And just quickly before I wrap up here, like TD Cowen talking about that Loblaw's ownership in EQ expecting to go up to 25%. Loblaw is also expected to start buying EQB shares in the open market with that goal to reach 25% over time. So this is just maybe the beginning of something even bigger.
Okay, we'll see where it goes.
Yep.
Lindsay, thanks as always. BNN Bloomberg's Lindsay Biscay. Of course, coming up in about 20 minutes, we'll be talking to the CEO of EQB, Chadwick Westlake. That's up and again, about 1:40 roughly Eastern time. So what's trending today? Let's take a look. TSX leaders that we're going to look at, EQB, as we were talking about, of course, it is trending right now. It's buying PC Financial, and look at what it's up right now, more than 10%, or sorry, more than 12%. It's down still 10.7 for the year, but up nearly 13% today on that news. Descartes System, another one, up 9%. Was what we were looking at, but now it's just looking now, it's up 12%. So these things are soaring right now. This changes are just in the last little while since this story was written. Q3 revenue tops estimates. Another one moving today, MDA Space up 5% earlier. Let's see where it's up. It's up 7%. We got a trend going on here. I'm going to wait for that board to show up before I read the numbers. And it's because of a contract awarded by the Canadian Space Agency for Constellation Mission Satellite. Now, another one, Skidoo and Sea-Doo maker BRP is up. Q3 results beating there, so that's good news for them. They're liking those numbers. And Orla Mining up about 2.3%, announcing inaugural dividend program. So those are the ones that we're paying notice to today. Up next, we'll look at how tariffs are affecting toy sales this winter with our next guest, Laurie Schack, President and Chief Toy Officer at the Toy Insider. That's after the break. All right, it is the holiday season. That means toy sales will be jumping. To explore what's driving the toy business this year, let's bring in our next guest, Laurie Schack. She's in here in person, President and Chief Toy Officer at the Toy Insider, and you even brought me some gifts. Thank you for that. I appreciate it.
Of course
I'll play with these after the show.
I don't show up without toys.
This is big business toys.
It is.
And of course, one of the things that was a big concern for a lot of people, supply chain issues, tariffs, talking about that. What kind of an impact is that having this year?
Not as big as we thought.
Really?
Different in the U.S. than Canada. I'll talk about both. more of an impact in the U.S., and everyone was so worried about what are the prices going to be. But what's actually happened is everyone in the supply chain has gotten involved. So from the retailer, the manufacturer, the factories, and everyone in between eating a little bit of those tariffs. In the U.S., we have single-digit increases. In Canada, and we're just talking toys now,
yes,
barely at all, because there's not a whole lot of Canadian-U.S. trade in the toy business.
In the toy business, they come in from China, they
right,
come in from
exactly.
Asia.
So it really has been something you haven't felt. Now, something interesting happening in the U.S. toy market is sort of this price strategy thing that no one's talking a lot about. But essentially, when you look at the preschool toys, the toddler toy, that young market, those prices are flat. And where they're hiking them up is more that adult, kidult collector. So that's where you're seeing larger price hikes.
Where they can make the money, because the people have the money and they probably have the hunger for those
They
things.
have the hunger for it. You don't want to ever deprive your kids, right? Yeah. So they're going out, they're shopping for their kids, they're not really feeling the difference in their pocketbook. And then, open up that wallet because, I want the next Labubu or Star Wars or whatever it is that they're going after. And they'll spend the extra dollars.
And just how big a market is that with the kidults?
It's huge. Everyone's getting in. So there's a lot of ways to look at this. You have a lot of your bigger toy companies, Mattel, Hasbro, that have lines that are just for the adult collector. Hasbro has Pulse. Mattel has the Creations line that you can just go and buy direct. Lego has the adult collector series.
I think Lego was probably one of the leaders for this.
Amazing. And even Jazzware's not public, but they have the vault. So all of those, and that's all adult.
And is that a growing trend, or is there a worry this is just a phase?
Oh, no. So there's something new happening this year. Again, adult. Kids will get involved, but it's that whole K-pop, the Demon Hunters. So huge excitement around this. And you have Hasbro and Mattel for the first time as co-licensees on a single brand. So the monopoly from Hasbro is off the water and hitting shelves as we speak. And for Mattel, there's pre-orders going for the fashion dolls. You won't see them till next fall.
And they're pre-ordering now.
Pre-ordering now. And the Funko has it all together. That's already on shelves.
And is this causing any supply chain issues? Are they managing to keep up with this? We talked about it with other industries for a while because of what we unfolded with the pandemic and everything, but is this causing any strains?
No, you know what? At the beginning with all the tariffs, things sat. So there's a lot of product this year that's hitting shelves late, but it's not causing any major disruptions.
And what about the stores themselves? Who's moving toys right now?
Well, that's interesting because in Canada, there's a whole lot going on. So your big box stores, not doing so great. So let's talk about Toys R Us, TRU. They're down to just 40 stores with dozens of them up for sale. Mastermind, Indigo, they did great during the pandemic. Now they're kind of trying to find themselves. But then you have these great specialty stores. You have one called Cowtown Toys and Candy. One guy owns it. He's got over 30,000 SKUs in this store.
Wow.
And he keeps growing. So it's become a destination for families, and they're coming from like 2 hours away. You also have a store called Village Toy Castle. And this guy's trying to bring toy manufacturing back to Canada. Again, huge destination, one store, and he's got a retro museum there. So you have shopping, you have the museum, so that's a big deal. And then you have GameStop, which has now become EB Toys, single owner, but he's also a co-owner of Mastermind, Imports Dragon, and McFarlane Toys. So this is sort of a mass specialty because there's many of them. And the other thing that he's got is trading cards, by the way. That is a big place for toys, collectibles, and trading cards.
And trading cards are huge demand right now, aren't they?
Huge. So the trading card, let's talk about where the market is. The U.S. market is up 7% in sales, Canada 17%. These numbers, by the way, are from Circana, just so you know. So in the U.S., of that 7%, 70% of that growth is coming from trading cards, all kinds. So whether we're talking about your Pokemon cards, which are on fire, the mega evolution, or we're talking about your NFL, non-sports, they are just on fire. Followed closely by collectibles, also up about 35%, and licensed goods up 14%.
All right, one last question, I guess. AI, NVIDIA chips, things like that. Are those factors at all? Shortages causing any issues?
I don't know that they're causing any issues. You know, when you're talking about the electronics in the toy industry, I mean, obviously it affects everything that's using those chips, but I think it's a bigger problem with grown-up electronics like, you know, cars and stuff. So I won't say that it's going to make anyone lose any sleep. I think they're still going to be able to get their Nintendo Switch 2 or their PS5. I don't see any problems there.
Okay, we'll leave it at that, but thank you very much, Lori, as always, for joining us.
Thank you.
Cheers. I was Lori Schacht, President and Chief Toy Officer at the Toy Insider. Coming up, Vancouver-based Longhouse Capital Partners is joining forces with a big Canadian bank. We'll hear from the CEO and co-founder, Fred de Blasio, after the break. CIBC shares are up today. The bank raised its dividend and beat revenue estimates in its fourth quarter as it reported a 16% surge. That's a very different number compared to the year before. Strong performance in its capital markets business helped drive results, and the Toronto-based lender also saw strength in its Canadian and U.S. commercial banking and wealth management units. The bank also decided to boost its dividend to $1.07 a share. CIBC is continuing a two-year streak of earnings beats. Shares of Bank of Montreal are seeing some pressure today. The lender beat earnings and revenue estimates in its most recent quarter, but investors seem to be focusing on a drop in net income. BMO says that metric came in lower due to the reversal of a legal provision in the previous year, a write-down related to its planned sale of branches in certain U.S. markets, and costs from acquisition-related assets. In October, BMO struck a deal to sell 138 branches in 11 states to First Citizens Bank and Trust. Meta shares are climbing after reports that CEO Mark Zuckerberg is considering significant budget cuts to the company's metaverse division. According to Bloomberg, executives are discussing reducing spending on virtual reality and other projects by as much as 30% next year. The move could include layoffs as early as January. The Metaverse Group has racked up tens of billions in losses since 2020. There's 2021, make that. Insiders say Meta now wants deeper cuts because interest in the technology hasn't materialized as expected. And taking a look at the markets right now, the rally continues at the TSX. It's up by 1.15% right now. Some of the banks helping drive that up. And U.S. markets actually in record territory, TSX Composite again. And the U.S. markets in the green now, but not by much. Most of them up by 0.1 to 0.15%. Canada's big banks are partnering with Indigenous-owned financial firms across the country. In April of this year, Indigenous-owned asset manager and strategic advisory firm Longhouse Capital Partners joined forces with CIBC. Longhouse is raising capital to build a $1 billion fund to finance major First Nations projects in Indigenous communities like wireless towers and transmission lines. We spoke with Fred de Blasio, co-founder and CEO of Longhouse Capital Partners. Take a listen.
Simplistically, Longhouse is an Indigenous-led investment platform that's built to deliver, frankly, the missing piece in Canada's infrastructure strategy, which is access to scalable, affordable capital for First Nations to participate in Indigenous equity. And we're seeing that through a blended finance approach where we take market-based capital and we marry that to all of the existing federal and provincial loan guarantee programs that exist across the country. And according to some of the McKinsey research we've unleashed or were able to find, it looks like Canada's infrastructure gap is about $200 billion per annum, which is a huge number for the next decade. So you're looking at well over $1 trillion of investment opportunities. Now, contrast that with the capital available through those blended finance solutions like the Indigenous Loan Guarantee Program that the federal government has put forth, which is $10 billion. When you aggregate all of those numbers, you're getting to about $20 billion, and that's a one-time $20 billion. And if you contrast that with the $200 billion required on a per annum basis for, let's say, the next decade, you can quickly see that there's a mismatch between what is required and what is available from a loan guarantee program. So Longhouse really allows for that blended capital to take place and delivers significant amounts of capital for First Nations to take advantage of the equity call option rights that they've been afforded through UNDRIP, which was ratified back in 2021.
Okay.
Oh, that's great. Fred, I'm wondering, we always hear about a lot of infrastructure projects getting bottlenecked with permitting delays and approval delays by various levels of government. Do you believe that you're going to be able to fast track some of these projects in order to expediently be able to ameliorate some of the deficiencies within infrastructure within the First Nations communities?
So I would say that First Nations are definitely open for business. And I think when you partner up front with First Nations, you quickly realize that not only are they loyal, but they're fairly sophisticated, and they assist in countless different ways to accelerate projects. I had the good fortune of working with a nation out west where we were able to deliver $1.4 billion to develop their lands rapidly, and that was the Sanok development here in British Columbia. And notably as well, our current Minister of Energy and Natural Resources, Tim Hodgson, when he was at Hydro One, he instituted a wholesale change in the approach Hydro One has with First Nations, which I think has served as a template for the rest of the country. And in a nutshell, what he did was he firstly took the Indigenous Relations Group out of the risk management group and put it into the business development group. So a very significant difference in terms of the approach to First Nations. And he quickly realized that if he was going to double the rate base in Ontario, he needed to become the partner of choice for First Nations. And I won't bore you with all the details, but suffice it to say that here we find ourselves with the Chatham to Lakeshore transmission line, which was built, I think, 15% under budget and 18 months ahead of schedule. So when I hear comments about, the First Nations are slowing things down, I'd submit to you that when you partner with us and you do so at the front end of projects, in the spirit of free, prior, and informed consent, you'll find us very willing partners who are practical and who like to get to solutions that satisfy everybody. And I'd like to say that what is good for First Nations, frankly, is good for all Canadians. And given that Indigenous equity is now a federal priority, I think it just hastens the speed at which we can operate under the new constructs.
And now you have CIBC on board with you. How is that unfolding? And are other banks showing interest in this?
The CIBC has been a terrific partner for Longhouse. It's a big six bank, and getting that kind of seal of approval, if you will, is a manifest improvement about just our own, frankly, against just our own reputation. We went through an extensive due diligence process in order to be placed on their institutional platform, and they have been nothing but outstanding partners for us. Not only are they making introductions, they're helping us raise capital, and frankly, we're incredibly excited at what's already transpired, and we look forward to some announcements in the new year that I think they will be proud of.
All right, and are you looking at any private investment, or are you getting private investors on board with this as well?
So the way we operate is we're in the market looking for institutional capital. We're about to close on the first 300 million, which should be done in the first quarter of 26. And that will be for 300 million. And that is institutional capital. So think large insurance companies, et cetera. We combine that with the projects we advise on with what is available from the loan guarantee programs and what we refer to as concessionary capital. So we blend market-based capital with concessionary capital. So you get to a weighted average cost of capital that's substantially lower than if you were trying to just find equity dollars, which typically is much more expensive. And so we're seeing an acceleration of that. Large corporates are keen to do business. And, this country will be rebuilt through the participation of First Nations. And so Longhouse provides what we feel is a market-ready solution by blending those private credit and federal tools in a way that advances the country's desire to build infrastructure, which, of course, is good for all Canadians.
And that was Fred de Blasio, co-founder and CEO of Longhouse Capital Partners. After the break, we'll be joined by the CEO of EQ Bank to discuss the company's latest deal to acquire PC Financial from Loblaw. That's next. EQ Bank stock is surging as the parent company of Equitable Bank is buying PC Financial from grocery chain giant Loblaw, a deal worth an estimated $1.3 billion. We're going to get some clarification on that. We'll also include all of Loblaw's insurance companies. Let's get more on this from Chadwick Westlake, the president and CEO at EQ Bank. Chadwick, thank you very much for joining us. Just to clarify, we saw, I believe, $800 million earlier. Now we're saying $1.3 billion. Can you explain the discrepancy, the changes on that?
Sure. We're so excited. No, thank you. Thank you, Roger. We're so excited about this transaction. The deal value is about $800 million. The difference in the $500 million is excess capital that they can take out of the business. And we'll take it at that 13% for $800 million, which is an excellent deal for both parties.
All right. So why go ahead with this? What did you like about it from your side?
Absolutely. I think really important when you step back and think about this transaction, this is a great day for Canada. This is a great day for Canadian banking, for bringing change and more choice in Canadian banking, bringing better value to Canadians. It's a very important part of this. And the time was right. We've thought in our strategy for years about how do we bring the challenger to Canadian banking, to bring more option and competition. And we thought, payment solutions are very important. We need to add that to EQ Bank. And I think similarly, Loblaw thought, how do we bring the best of our PC Financial to Canadians? And we saw aligned culture, we saw aligned businesses. You add these products and teams together, and you have the dominant challenger serving millions of Canadians underpinned by PC Optimum.
And how do you say Canadians are going to benefit from this then?
More product offers, absolutely. And now EQ customers get the benefit of PC Optimum, and PC Financial customers get the benefit of the EQ products. And together, you actually can bring better value, innovate even faster. We can be available where the customers are across stores across Canada. And we both have modern technology stacks and a belief in low and no fees and new and different options, especially for underserved Canadians. And we think there's millions of Canadians that will benefit from this.
Now, any concerns with this deal? The stock levels, the shares are down. The last number I saw was about 12%, and that's what they're going for. Any concerns that it's a little low for what you're doing?
No, our stock. When you have a great deal, right? When you have a great deal, you do the great deal. That's what matters, and that we're creating great shareholder value from this. This is very good for our customers, for our employees, for all of our stakeholders. And this is accretive in year one from an EPS and an ROE perspective. So that's what we're thinking about in the long-term value creation. And this is a partnership. I'd say Loblaw is looking at this as an investment. This wasn't a sale process. This is about a partnership in Canadian banking. And that's what this is. And we're going to create a lot of shareholder value that way.
And Loblaw is staying involved with this. They're going 17% and buying back up to 25%, or buying up to 25%, right?
That's right. That's right. They'll have active involvement in this, and they really believe in the purpose of this. So they will get 17% at closing, which we expect will be sometime next year. And then they can buy up to 25% of the company, as well as get 2 seats on our board.
And what made them decide it was time to sell?
Well, I think they were looking at how do we take PC Financial to its fullest potential. And where is their shared culture in products? And they saw EQ Bank, which is literally the trademark challenger bank in Canada. And they got to spend some time with us. And they saw our management team, our track record, and they thought, we want to put this in the hands of bankers, and we want to stay part of that. So we've trusted each other. We've spent a lot of time on this. We've spent about a year getting ready for this. So the time was right to really step in and really support our bank to take that forward with their active involvement.
Now, you're coming out of your earnings report as well. Missing estimates, earnings per share, $1.53. The estimate was $1.99. Is this the time to be doing something like this?
Absolutely. It's right on strategy. And this is such an important time, I think, for competition in Canada and competition for Canadian banking. I've been in the job about 100 days now, and we've refocused our company around a few things that matter most. And 2025 is behind us. That was a difficult year, but we're in a new chapter now. We couldn't be more excited about what's ahead. And this is exactly on strategy with completing our product shelf, bringing those payments and digital solutions together with all of the rest of our products and services. And the time was absolutely right. I've never felt we're better positioned for more competition and choice for Canadians than now.
Now, some of the analysts have concerns about credit as an issue for the bank. With the credit weakness broad-based across the portfolio, I'm just reading some of the notes here. Sure. The uninsured single-family book continue to be affected by soft housing conditions. Are these not concerns for you? Should they not be looked at before you think about buying?
Yeah, nobody has a crystal ball on the market. What I can say is we closed Q4 with a very strong position on our credit book. We believe it reflects all the forward-looking indicators of where the economy may go. Again, you don't have a crystal ball to say, but we feel very well provisioned now for what's ahead. And we do have built into our models some downside readiness. The housing market may be slow for a little while. Canadians are struggling, and we want to help them with better products and solutions on the other end of that. So we do think we've closed the book on a difficult year, and we're coming into 2026 from a position of strength.
And what do you see going forward? What do you see over the next year then?
Yeah, we provided some outlook where we see from where we exited Q4 with ROE, we see ROE expanding pretty meaningfully, 400 or 500 basis points next year. We see our earnings per share probably increasing in the range of 12 to 15%. And we see credit, based on everything that we know now, stabilizing and moderating it more for us next year.
And what's giving you that confidence?
Well, we understand our loans. We're a lender. We've been lending for 56 years. That's how EQ was actually formed. And we're going to 10 years as a digital bank, but underwriting and lending is our expertise. So we've taken apart our lending book. We've looked at all the stress scenarios in the market. Mm-hmm. And we believe the provisions we've taken position us well for some downside based on what we know. Anything can happen in the market, but we're well positioned for everything that we believe to be true in the next 12 months. Yeah.
Okay, so that's your first 100 days. They talk about that with governments, that first 100 days. What's next? It crossed my mind earlier. Yeah. I mean, is this setting up for EQ to be sold maybe? Because now you've got a bigger pie that looks a little better?
I wouldn't say that. I came back because I believe in Canada's challenger bank and the need for better choice and options for Canadians. And we are only focused on Canada. So I'd say I don't think about this company being sold. I think about this company growing and becoming stronger. And I think everyone wants to see us compete. We are the challenger. We can actually bring competition to the incumbents. And we're going to build it and we're going to execute to make sure it is the best bank possible for millions of Canadians. Our scale is changing completely with this now.
So will you build it through further acquisitions or just trying to build customers?
We're going to execute what we started with PC Financial. We're focused on our core businesses in single-family lending, reverse mortgages. We're a large commercial lender, especially on the insured side and helping with affordable housing. And we're going to finish EQ Bank now with this product shelf. You might see more on the wealth management side come up, but first we're going to execute this and get our core businesses going, which we are. And we have the leadership team in place. We'll have the brand recognition in place where before probably 80% of Canadians didn't even know we're here. Now they're going to know we're here and we're going to serve all of them very well with these new solutions.
Okay, Chadwick, thank you very much for joining us today.
Thanks for having me. Really appreciate it.
And that was Chadwick Westlake, President and CEO of EQ Bank. Still ahead, today's Market Movers with Bloomberg's Matthew Griffin. Time now for some movers south of the border, and we are joined by Bloomberg Equities reporter Matthew Griffin. Matthew, how are you, sir?
I'm doing well. How are you, Roger?
All right, I'm doing all right. Probably better than Snowflake right now. Some concerns about it.
Yes, Snowflake shares down more than 11% today after the company gave an outlook for margins and sales in the current quarter that was a bit lackluster. This is a company that makes software for managing data in the cloud. Also a player in AI, trying to sell AI products. They said that their adjusted operating margin is expected to be 7% in the current quarter. Analysts were looking for 8.5%. Also some weakness on the product sales outlook. But the concerns here may be broader than specific numbers. What my colleagues over at Bloomberg Intelligence say is this shows that the company isn't really seeing strong gains yet from those AI efforts. And if we think about the markets lately, the past month or so, investors have really been laser focused on gains from AI and on the return on the investments companies are making. So this stock's still up more than 50% year to date. A lot of enthusiasm in general, but when you have a rally like that, there can be pretty significant drops when those narratives are questioned, and that's what we're seeing today.
All right, let's move into the AI world, if we can do that. Meta expected plans for its metaverse efforts. Where's that going right now? I'll try that in English. Where's Meta's plans heading for the metaverse effort? They've made some changes.
Yes, so what Bloomberg reported today is that executives are considering cost cuts of as much as 30% for the metaverse effort. This, of course, is a project that defined the company just a couple years ago. You know, we are talking about a firm that is named Meta, that is no longer named Facebook, but the metaverse, this idea of a virtual world where people would socialize, do business, where you could sell virtual products, it has not taken off in the way that Mark Zuckerberg was hoping, in the way that he was betting. The company really shifted focus into artificial intelligence, and that's why you end up with, according to people familiar with the matter, plans of far deeper cost cuts in this division than elsewhere. If this is what the company decides to do, the people familiar say that this would lead to layoffs as soon as January. Stocks up about 4% today on this news. Meta still down since their latest earnings report in October raised some concerns about the level of spending on AI. So this news setting off a bit of a relief rally in those shares.
And could this be a bit of a death spiral for the metaverse? Yeah.
I mean, you know, with a new technology, I would always hate to speculate. You know, the only thing I would say is this is a sign that it's not a central priority in the way that it once was. This is something that Mark Zuckerberg has really largely avoided talking about on their earnings calls lately. And, you know, you hear them talk a lot about AI. This is the way that technology companies have evolved in their marketing the last couple of years. You used to hear a lot about the metaverse, NFTs, that kind of thing. And now it's AI, driving the narrative, driving the stock prices.
All right, and let's get something that we can actually have tactile feeling to. Build-A-Bear, not a good report from it.
No, so Build-A-Bear Workshop, of course, they're the retailer of customizable teddy bears. Investors not feeling the warm and fuzzy feelings that those stuffed animals are supposed to create. Stock down as much as 21% today. That's the most intraday since 2022. Their fiscal third quarter revenue missed expectations, and they're also starting to see tariffs bite. It was gross margin fell 40 basis points year over year, largely due to tariffs, and the company said they expect to see those impacts continue into the end of the year, into next year. And it's just a reminder that the broader market has rallied past the trade turmoil this year. But when you look at consumer stocks, there really are pockets where this still matters. So Build-A-Bear today, but if you think about Nike, furniture retailer RH, there are still stocks seeing a lot of volatility that have been left out of the big rally this year. So again, there are corners of the market where the trade war still matters.
Yeah, and this next quarter will be a big one for all of them, won't it?
Yes, you know, something that strategists, investors have been telling me is once we get closer to the end of the year, companies get rid of the inventory that they bought before the tariffs. Maybe you see a little bit more of an impact on the consumer. That's when things start to bite.
All right, got to wrap it up there. Matthew, thank you as always. Bloomberg's Matthew Griffin. And that wraps up this edition of Trading Day. Thanks for joining us. Have yourself a great afternoon.